This conference will now be recorded.
Well, good morning, everybody, and welcome to this webinar on employee ownership trusts. I hope you're going to find this interesting. You're not going to have to listen to me today. It's going to be given by our tax director, Mr. Chris Bentley, who's going to run through all the ins and outs of what employee ownership trusts are all about. Just as a reminder, if you want to ask any questions, please feel free to unmute yourself or stick a question in the chat box. You'll see a screen, top square box in the top right hand corner of your screen. If you click into that, you can add in any questions that you might want to add. This webinar is being recorded and will appear on our YouTube channel later on today. So if you've missed anything, then you can always come back to us or go back and have a listen to it again. If you want a copy of the slides, please feel free to ask and we can email those slides over to you. We have a lot of social media content available to you. So if you want to go to YouTube, you can pick up on any other webinars that you might have missed. There are also some podcasts on there. We've recorded now half a dozen podcasts, so they're all available to you. So we are on YouTube. We're also now on Spotify. So if you want to listen to us on the way home in your car, all you need to do is go to Spotify and search for Harts Limited. We're also on Twitter and follow us on LinkedIn. There's lots of good stuff going on LinkedIn as well, so please feel free to follow us on that. Without much further ado, I'm going to hand over to Chris to lead us through employee ownership trusts. Got any questions? Just shout out. Over to you, Chris.
Thank you very much, Stephen, for that introduction. As Stephen says, today's webinar is on about employee ownership trusts. And so I will start with the required and inevitable disclaimer to say that the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of our affiliates for any action taken or any decision made to refrain from action by the attendees or later viewers of this presentation. Before we jump into employee ownership trusts, I think it's worth just going through the current state of the budget or mini budget or budget that wasn't a budget that was made about 4 weeks ago. Talking to clients this week, despite what's been going on in the media, there is some confusion around what's still coming into force, what's been repealed. So I'm just going to start with a slide that takes us through the status of the various announcements made last month. I've deliberately put a date on it as at 20th of October 2022. Things are changing. I'm not confident that there won't be further changes. We saw what went on in Parliament yesterday, last night. Who knows what's going to happen over the next few weeks and months. So as things stand as at 9:30 a.m. on the 20th of October 2022, we're still expecting the national insurance cut to go through. So that means a return to the 21-22 rates of 13% and 3% for employee contribution, 12 and 2%, that's 12 and 2% for employee contributions and 13.8% for employer contributions. Those changes are being made with effect for payments from the 6th of November. The stamp duty land tax cut, we understand, is also remaining in force. So zero stamp duty on purchases of first properties up to 250k, and also the increase in the first time buyer relief. Second properties will of course still continue to have the 3% supplement. I've put the corporation tax increase to 25% under 2023 under going ahead. This was initially announced by one of Jeremy Hunt's predecessors, Rishi Sunak, some months back. Then it was abandoned in the mini budget last month. It's now back in place. So those of you with companies with profits over 50,000 will see an increase in corporation tax from next April. anyone with an investment company will also see an increase in corporation tax from next April. We've then got the various proposals made in the mini budget last month, which have been abolished or withdrawn. So previously it had been announced that top rate tax, so the 45% rate of income tax or 39% currently on dividends, would be abolished next April. That's now been abandoned. The top rate remains in place. There was also a proposal that dividend tax rates would return to the levels they were last year. That's 7.5% in basic rate, 32.5% at higher rate, and 38.1% at top rate. That's also no longer going ahead. So tax rates on dividends will remain 8.75%, 33.75%, and 39.35% at the basic, higher, and top rates respectively. We've also seen the proposed reduction in the basic rate of income tax from 20% to 19%. That's been postponed indefinitely. My reading of that is cancelled for the foreseeable anyway. We've also seen a change on the IR35 rules. It had previously been announced that we would abolishing the Engage or Decide rules brought in 2017 in the public sector and in 2021 in much of the private sector. That abolition is no longer going ahead, so the engager will continue to decide whether contract is inside IR35 in the large majority of cases. Finally, and given that energy prices are behind a lot of the government's calamities, or certainly some of them, it would be wrong of me not to mention the arrangements for energy price support. The announcements which were made to support consumers and businesses with their energy costs for the next 2 years, those promises made in September have now been changed. The current arrangements are now only in force until March 2023, and the expectation is that the government will announce a much more targeted scheme to take its place thereafter. So if you're a heavy energy user, you've got 6 months, I think is what the government is saying there. So if we now move on to what you've all come onto the webinar to hear about, and that's employee ownership trusts. I think before we jump into it in any depth, it's worth asking anyone who's considering an employee ownership trust, why are you exiting? Why do you want to exit the business? And what do you want to happen to your business? I think those two questions are fundamental to whether an exit via an employee ownership trust is right for you. Yes, there are tax breaks, but as we'll see, these two questions should and will be front of mind if you're going down this route. So a quick recap on the options you might have if you're looking to exit your business. For most people, they think, well, I'll sell it. Sell it to a third party, get a nice wedge of cash, possibly a short-term handover period, and then I'm done. That's probably the most common exit route still. For some businesses, it's appropriate for management to buy it. So management will buy your shares off you. That can be structured in a number of ways, but you need, first of all, a management team that's capable and wants to buy it off you, but also a management team that's able to raise the necessary finance to buy it off you in most cases. We then look at today's webinar, which is on transferring to an employee ownership trust. Similar to a management buyout in many ways, but benefits all of the employees, and importantly, it can often be structured in a way that means that no one has to raise finance, which can be a real advantage when it comes to selling a business. Many of your employees, if you're looking at the management buyout route, may just not have the funds or be able to have the resources to be able to raise the funds, even if they wanted to. Of course, there's then the other options. You might be looking at passing the business to the next generation, or you might even have received an unsolicited offer. But really, the employee ownership trust is to be compared against the first two, the planned sale or the management buyout. If you're thinking of passing to the next generation, very, very different sets of considerations. And if you receive an unsolicited offer, well, who knows what that offer might say. What I'll say, though, in terms of the employee ownership trust is that the highest valuations for a business sale are usually achieved on third-party sales. And this is particularly where the buyer is making a strategic acquisition. And valuations for management buyouts and for transfers to an employee ownership trust are typically lower. The reason for that is that a management buyout or an employee ownership trust will typically be done at an arm's length valuation price. So that would be where a hypothetical willing buyer and willing seller are operating in a vacuum. No particular pressures can be assumed on either party. So it's very much a central point valuation. You've not got a distressed seller where, for example, a business might go cheap, but equally and importantly, you're not going to get a buyer making a strategic acquisition, and a buyer making a strategic acquisition will often pay over the market value for that business because it's a strategic acquisition. However, on the other side, if you're transferring to an employee ownership trust, it gives you as seller greater control over the business post-sale. You can maintain a minority shareholding. It helps you preserve a legacy. It helps you preserve the ethos of the business if that's important to you. It gives you a semi-retirement option in many cases, and it doesn't require management to raise funds. Yes, you might want some funds raised up front, but there's no requirement. The sale can be structured in such a way that management don't need to raise funds. I'll have a very quick look at tax on a business sale as well as part of this introduction. The first point to note is if you sell the shares in your business, and I'm assuming here we're talking limited companies, not partnerships and sole trades. When you sell the shares, the capital gains tax rate is generally 20% for higher rate taxpayers. However, in most business sales, in fact the large majority of business sales, it will be reduced to 10% on the first million because you'll get business asset disposal relief, the relief that was previously known as entrepreneur's relief. By contrast, if you were to sell the trade and assets of your limited company, the company would pay corporation tax on the proceeds, which we would assume going forward to be at 25%. And then when you liquidate the business to get the company out, liquidate the company, you'd then pay capital gains tax at the rates above. That means selling the shares is a lot more tax efficient than selling trade and assets. However, if you dispose to an employee ownership trust, so you're not selling to a third party, you're not selling to management, you're disposing to the employee ownership trust, one of the benefits of that is that there's a 0% tax rate as long as you get the structuring of the transfer to the trust correct and you remember to claim it. So I'm now going to move on to the short section on what is an employee ownership trust and how does the trust work. So the starting point is an employee ownership trust is a trust that owns shares for the collective benefit of the employees. The government introduced this as a tax-advantaged route for business owners to exit because they wanted a model for trading companies which promotes and encourages employee ownership and participation. So if you want your employees to be a part of the business and you see them as an important part of the business, this may well be for you. It also allows the business owner to exit in a way which can secure and continue the direction and ethos of the business. Employee ownership has existed for a long time. For example, the John Lewis Partnership has been around for several decades, although the tax-advantaged regime, which we're talking about at the moment, was only introduced in 2014. Now, I talk about the tax-advantaged regime because most people who are going down this route are doing it partly for reasons of preserving their legacy and perhaps with a bit of altruism, but also they're looking at the tax advantage. I don't think when John Lewis put his business into trust, I think he gifted it. There's certainly no expectation that to get the tax benefits there's any kind of gift or sale at an undervalue. But as we go through the rules in a bit more detail, you will notice that there is a bit of a spirit of you're doing this for the employees as much as you're doing it for yourself. And because you're doing it, the government will give you that tax break in terms of your capital gains tax. It's interesting that a large number of companies across a number of sectors are using this new model. We've worked with a couple of businesses in very different sectors, although both are what I would call professional type businesses. It's not just that sort of business though. Yes, Oliver and Co, solicitors in Chester, announced earlier this week that it's converted to an employee ownership trust, but also some well-known businesses. Richer Sounds, for example, has used a new model. I think they converted about 3 or 4 years ago. So it could be for a wide variety of different businesses. So how does it work? The starting point is that you sell more than 50% of the company shares to the trust, and the company then continues to trade. It's important that the sale is more than 50% to get the tax break. If you put 51% in, you get the tax break on that 51%, but you won't get the same tax break if you were to put a further tranche of shares in. Similarly, if you thought, you know what, I'll put 49% to the employees and I'll keep 51% to myself, you won't get the tax breaks. It has to be put into majority employee ownership, and the tax break applies only on that transfer of a shareholding exceeding 51%, that first transfer. And of course, as I've mentioned before, you have to remember to claim that tax break in your tax return. It's not automatic. So having put the company's shares into the trust, the company will continue to trade. It's no longer run by you as the business owner. It's run by an employee management team on a day-to-day basis. The employee ownership trust owns the business and has the controlling shareholding. You might be a trustee, but you're one of several, and you're now a minority shareholder. So you are handing over control of the business to a management team. Where we've seen it done before, there may be 3 trustees, one being the former owner, who is still in place because there is deferred consideration owed to him or her, one being the employee representative, and one being an independent trustee. In due course, the expectation would be that the former owner will step back, particularly once he or she's been paid all of their deferred consideration, and that the trust is run by the employee management team and the company itself is run on a day-to-day basis in the same way. The employee ownership trust, which of course holds more than 51% of the shares, has to benefit all employees of the company. It can't just benefit the directors and managers, it has to be everyone. Where we've seen a company converting in the past, we have seen them remove small parts of the business where it was not felt appropriate for those employees to benefit for one reason or another. They take that out of the company before the company is passed over to the employee ownership trust. There's also a restriction here, is what I'm saying about there's a degree of avoiding there being any tax planning. It's being done for the employees, is that anyone who owns 5% of the shares and anyone who is related to them can't be a beneficiary of the trust itself. So if you retained a 10-20% shareholding, if the surplus funds in the trust, they can't be distributed to you. And there's also a cap on the number of directors and employees owning shares directly in the company. So this is the up to 49%, which is not owned by the trust. The number of individuals having personal shareholdings is capped at 40% of the number of employees of the company. So let's say you've got a fairly small business with 10 employees. The trust is the majority shareholder. You can only have 4 other people holding shares personally. So come on to the commercial benefits of exiting to an employee ownership trust. And there are a good number of these. It's a very good way of addressing succession issues and preserving the ethos of the company, leaving a legacy. You may have really set up your business in your way you want to, you've got management bought into it, but either the management team there's a large number of them and none of them could take it on themselves, or they can't raise funds, or they've not got the willingness to go over and raise funds. You can still pass that ethos and that business on without the obstacles of them actually needing to raise funds and pay you up front. Of course, you will get paid for the business, and it can be paid out of the future profits of the company, which are contributed to the trust and used to pay you your deferred consideration. Similarly, if you're the business owner, you don't have to leave on a sale. You might be thinking, I want to wind down over 3 to 5 years. So you may well say, yeah, majority of the shares go into the employee ownership trust as part of my planning. I'll remain a minority shareholder for a period of time while I wind down. And then at the end of it, I'll either retain it as something for the family, or I can sell that to the trust. The options are there. The one downside for many business owners is that if you're no longer the majority shareholder, you're not going to be receiving dividends for your income in the way that you have done historically. You might need to go pay as you earn. That said, with the increase in corporation tax and dividend tax rates not being cut back to last year's rate, it might not be the end of the world. The difference in tax efficiency is far, far smaller than it has been historically. Another commercial benefit in exiting in this way is that you know your team have secure ongoing employment and involvement in the business. I know from experience that's an important part for many business owners when they come to sell their business, that the buyer is going to look after the staff because they feel a duty to those staff. I've mentioned the next two about financing. Another big benefit with an employee ownership trust is that you don't need to spend time and effort soliciting a potential buyer. For many business owners, that's one of the hardest and most time-consuming bits of selling their business. Yes, diligence can be very painful, but at least once you've got a suitor on the scene, you're working towards a goal. It can take people a long time before they even identify someone who might be interested in buying that business. Similarly, the diligence for a sale to an employee ownership trust is likely to be relatively simple, as the management team already know what's going on in the business. And of course, as I've mentioned already, you can have a hybrid structure. The tax benefits arise if you put 51% or more of the shares into the trust. So you might choose to put 51, 60, 70, 80% into the trust, with other shares held by yourself as founder or owner, and even some shares held directly by the management team, or even a combination of all three. There are plenty of options for structuring the shares that are outside the trust. There are also some significant tax benefits on exiting to an employee ownership trust, and that is the disposal of that 51% shareholding to the trust is tax-free, provided you claim the relief. So completely free of capital gains tax. The other tax advantage is that each employee can receive a bonus of $3,600 each year, free of income tax, if the company is majority owned by an employee ownership trust. That can be a nice benefit to your employees. For your key employees, it's probably not going to be the game changer, but for junior employees, you can see it being a significant bonus for them and an attraction to your business going forward. So what I would say in summary is that the tax benefits are attractive, but because of all the commercial considerations, what you're doing it, why you're doing it, how it needs to be structured going forward, typical levels of valuation, we wouldn't generally recommend that an employee ownership trust exit is pursued purely for the capital gains tax exemption or for the tax-free bonuses for that matter. So I've now just got a few slightly more technical slides on the conditions for tax-free bonuses. I won't go into a huge amount of detail on them, but they're there as part of how the structure works. So I've mentioned that a bonus of up to $3,600 per employee can be paid each tax year free of income tax if the company is majority owned by an employee ownership trust. Strangely, there's no exemption from national insurance. The bonuses are paid by the employing company, not the trust. And the key conditions associated with that are all employees must participate in the bonus pool on the same terms, although there is some flexibility permitted in terms of how you allocate those bonuses with respect to remuneration, length of service or hours worked. So as an example, you might determine bonus entitlement based 75% on salary and 25% on length of service. But as long as you've done that to every employee, so everyone in the bonus pool, you're fine. That's permitted, but you can't exclude people or exclude teams or only pay to management or anything like that. The tax-free bonus must be a genuine bonus and it can't form part of the employee's ordinary salary or wages. And of course, you are allowed to have other performance-related bonuses outside the employee ownership trust tax-free bonuses. So those are the bonuses that you might want to incentivize management team with. They're also perfectly permitted. They're just taxable in the normal way. So the trust can also provide benefits if there are surplus funds in there. There are slightly different rules applying to benefiting from the trust as opposed to the bonuses themselves, but they're very similar in terms of it must provide benefits on the same terms to all employees, and the same terms again doesn't mean equal amounts, and awards can be determined in the same way as for bonuses by reference to remuneration, length of service and hours worked, which means there is some flexibility, although you can't skew benefits to the advantage of particular employees. However, one important distinction here is that if you remain a 5% shareholder, and then you and anyone related to you can't actually be a beneficiary of the trust itself. So now move on to a bit on selling shares to an employee ownership trust and how that might work in practice. So the starting point is if you're planning to sell your shares to an employee ownership trust is to obtain a valuation of the company to determine the sale and purchase price. Now, we'd always recommend that the valuation is done on behalf of the sellers and the trust acquiring the shares. It's done jointly so that both parties are agreed and tied into it. We'd also recommend that for the transaction that you obtain HMRC clearance for this. This is to make sure that you're comfortable that you're getting your capital gains tax exemption and no unwanted tax nasties coming out of the structure. The reason I say that is the valuation cannot be excessive on a number of grounds. The first one is that you probably won't get HMRC clearance if HMRC think the valuation is excessive. They will see it as an effort for the business owner to try and turn income, so ongoing dividends and profits, into capital. It's also the case that if that does occur, the likelihood is the excess you receive over what might be market value is subject to income tax at dividend tax rates. So that could well be 39%, not your 0% capital gains tax you're expecting. There may also be problems with trust law, with the trustees buying something for more than it's worth. So that's why we think it's very important to have got a jointly agreed valuation and to get HMRC clearance in place to protect yourself. Once all of the valuation and that side is agreed, you've set up your lawyers who correctly constitute the trust to get your tax exemption and things like that. The employee ownership trust will pay for the shares over a period of time, typically. That might be funded by contributions from the company, for example, its future profits, or the trust might borrow to be able to fund the acquisition. Most commonly, though, we see it that the majority of the funding and sale price is deferred, paid over a possibly fairly significant period of time, and is funded from the company's future profits. That way, in terms of the business owner perhaps remaining involved, the funding coming from the company's future profits and being deferred, are all things that when you look at your revenue clearance, if this appears to be going at more than market value, it's a red flag to the revenue. So come on to how much is the business worth? The $64,000 question. It's extremely subjective, which means as there are very few comparisons available for most businesses. For listed companies, yes, you can look at the share price. You might be able to find something that's very similar. But for a small owner-managed business, there's nothing really in the public domain. There are indices which can give us a guide. There's previous experience. We can see what's going on. But it is very, very subjective, including in relation to how you put various things onto an arm's length basis. So generally, the business would be valued based on a number of years of recurring profits. The company's underlying profits would be adjusted to remove one-off items and put fair salaries in for the business owners. So how much would it cost you to employ someone to do your role? Would your role be needed going forward? Have you stood back from the business? All of that will go into the subjective question of what needs to go into the valuation to make it an arm's length recurring profits figure. Then typically average over 2 to 3 years. That's not always the case. If a business is changing rapidly, that's not appropriate, or you might weight heavily towards the current year. How has COVID affected the business? If you were very heavily affected by COVID in 2021, it would be appropriate to completely ignore that year in terms of valuing the business. It's not the same for every business. And then the multiple of recurring profits depends very much on the qualities of a particular business. It can typically range between 2 and even 8 or 9 if you've got very high barriers to entry, particular licenses, you're very, very niche, and you've got a very secure income stream. That's the exception rather than rule in a small business and on an arm's length basis. Because what I'm talking here, as I've said before, you're talking around a tax valuation for the sale, and that assumes a hypothetical willing buyer and a hypothetical willing seller acting at arm's length. You can't assume you've got a particular purchaser or set of circumstances. That said, you're still, as business owner, in control of the valuation. You've got the gift of timing that valuation to be beneficial to your exit value. If your interest is actually in pushing the valuation as high as possible. For example, if your business is growing fast, you might deliberately delay your planned disposals to the employee ownership trust to get another year or another 2 years of these good results with the high profits in place, because your business will be worth a lot more in a year or two's time with these profits having been made than it is today. But whether you choose to do that, it all comes down to why you're exiting and how much you want for the business and how much you want the business to have to pay you from its ongoing cash flows going forward. Because remember, with an employee ownership trust, it's not a third party that's paying you, it's your team. So people have different views on how far they want to push that. And then, of course, we go back full circle with a slide on the main alternatives to the employee ownership trust. The planned sale, and we did a webinar back in February talking about how you might prepare your business for sale. Similarly, management buyout. In many ways, it's similar to an employee ownership trust, except that a limited number of employees will take on ownership. In many sectors, that might be more appropriate in terms of how the business is run, but that will depend on your business as to what works best. Raising funds for a management buyout can be problematic. It can be relatively tax efficient structuring a management buyout, but it's not tax advantaged in the way that an employee ownership trust is. And then finally, if you're going down a completely different route of passing the business on to the next generation, we would really be asking you to talk to us about capital gains tax, inheritance tax, whether trusts are appropriate, whether we're looking at things like school fees planning or grandchildren. There's a completely different set of considerations there. And then my final slide before I hand over to, well, in fact, I will hand over to Stephen now to sort of talk through the next webinars we've got coming up, and then to let me know any questions that might have arisen.
Okay, well, I've got a couple of questions. If I could just ask Chris, what you say it's got to be available for all employees. How do you deal with joiners and leavers to the company?
There is a short qualifying period. You're allowed to keep people out during that short period. So if you get someone who starts on Monday, they're not entitled to everything on Tuesday.
Okay.
I can't remember off the top of my head the length of the qualifying period, but it is relatively short. In terms of leavers, they're not a problem because they don't directly own shares in the company. So it's the trust that owns the shares. So if you have someone who leaves, they just leave as a normal leaver.
Okay. Has anybody else got any questions they want to ask? The slides will be available and the whole webinar is available on the YouTube channel later on today. But if you want a copy of the slides, we'll arrange to get those sent out to you.
Can I just ask, sorry?
Yeah.
Can I just ask one question? You mentioned that once the EOT goes through, it'll be run by a management team.
Yeah.
Now, it's my understanding that the current directors of the company can continue.
That's correct. You can remain a director, but you're into a similar position to being a director without a majority shareholding.
Yes.
So you are beholden to your majority shareholder, who is the trust.
Right. But the directors can still run the company on a day-to-day basis. Yeah. Okay, that's fine. Thank you.
Thank you. Anybody else got anything they want to shout out? Any questions? Feel free to unmute yourself, jump in. Whilst you're having a think, the next events, well, we have quite a bit going on. 10th of November, we have the next webinar is giving the customer the wow experience. This is all about maintaining your customer and client relations, what you can do to improve it, what the best industry practice is, and so on. On the 17th of November is our business club. If you've not joined us on any of these, it's a great networking event. It's a lunch at Hollin Hall here in Macclesfield. And it's from 12 till 2, a great lunch, get a chance to chat to various people, well worth coming along to. If you want to join us, just go to the events page on our website, and you just need to click on the link there and you'll be able to join the event.
I would add on to this club, Stephen, we typically have 3 interesting speakers.
Yes.
So you'll learn something as well as being able to network, and the food's good.
Yeah, absolutely. And then on the 1st of December, something very important is happening, basis period reform. If you're a sole trader, our partnership, things are changing, and as is Making Tax Digital going to affect you, If you're a landlord, it's certainly going to affect you for making tax digital. So that's on the 1st of December. That's one you really need to put in your diary. And on the 15th of December, before we break up for Christmas, we're going to have it. Make sure you do a New Year's resolution for planning for the new year. Every business should have a plan. Have a think about what you want to do. We can give you some helpful tips and advice on what you need to put into your plan. And maybe you can join us and we can have a session in the new year. Has anybody else got anything they want to add? No? That's great. Thank you very much indeed for joining us. We'll stay online if anybody wants to ask any questions after the recording has stopped. Please feel free to do so. But in the meantime, thank you very much indeed for joining us today. If you've enjoyed this, please can you pass on the recommendation to somebody else to say, why don't you join these webinars? We'd love to have them on. If you've got any suggestions for any future webinars, please feel free to also to get in touch. So again, thank you very much for joining us and have a great day.